Hello, everyone. Welcome to today's non-farm payrolls webinar with me, Fawad Razakzada, and my colleague, Victor. Hi, Victor.
Hi, Fawad. The big news item that nobody cares about.
Indeed. I was going to say that this particular non-farm payrolls report might be a non-event, which is the bad news. The good news is that we are seeing plenty of volatility. And so it is possible that this could well be a very volatile afternoon for the markets, not just because of this non-farm payrolls, probably not because of the non-farm payrolls report, but because of the events happening elsewhere, specifically in Ukraine. We will cover that in a minute or so and talk about the non-farm payrolls data that we are expecting to see based on some of the leading indicators. And then we will share some live charts with you guys to highlight what's really moving the market and talk about specific levels on major indices, currency pairs and gold. So bear with us as we share the risk warning and the disclaimer with you first. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So in today's webinar, you all know what non-farm payrolls is. I'm not going to bore you with any information that's not going to be useful to you, but wanted to highlight the agenda for today, and I've already spoken about this, so let's crack on. Normally, the non-farm payrolls report is really important for the market because it gives you an indication of how the economy is performing, specifically about the jobs market and wages. And so the Fed usually looks at employment data in order to adjust interest rates. But, inflation has been soaring across the globe and especially in the US. To the point that the Federal Reserve had to bring forward its rate hike expectations, and the market is now pricing in about 6 or 7 interest rate hikes this year. Am I correct, Victor, in that?
Yeah, it used to be that before the events of the past week. I think that last time we checked on Tuesday, it was pretty close to 6, right?
Yeah, I think it was. So the Fed chair has come out this week saying that he is going to recommend a 25 basis point rate hike at their meeting next week. Not next week, the week after. So that's a done deal then, isn't it? So we are going to have today's jobs report and wages data, and then next week we have CPI from the US, and then in terms of data ahead of that meeting, major data, that's all there is. So in that regard, today's wages and jobs report are not going to change the outlook for the interest rate hike that is going to come in the next couple of weeks. But what it might change is the probabilities of future interest rate hikes, only slightly. So with that in mind, I don't think today's jobs report is going to matter significantly in terms of market reaction. Would you agree with that?
Most certainly.
Yeah. So for what it is worth, we are looking for just over 400,000 jobs, net jobs, for the month of February. This would be slightly less than what we saw in January, which was a big beat. Yeah. But in terms of unemployment rate, well, we're expecting it to ease further to 3.9%. And then I think that the key focus will be on earnings, right? So the average hourly earnings are going to be, well, they're expected to come in at 0.5% on a month-over-month basis, or 5.8% on a year-over-year basis, rising from 5.7% previously. So earnings are an indication of inflation, and so if we see a bigger number than expected, this will further raise the prospects of the Fed having to tighten their policy faster than they would like to. So that's the situation. Now, in terms of the headline number, we've seen some mixed data this week. The ADP private sector payrolls came in at 475,000, which was higher than expected. But just to highlight how inaccurate ADP are, for the previous month, they had reported a minus 301,000 jobs created, meaning that the US economy lost 301,000 jobs in January. However, they revised that upward to 509,000. So they were off only by about 800,000 from their initial estimates, which is a huge deviation.
Yeah.
So in other words, don't take ADP numbers too strongly, like take it with a pinch of salt. The other employment components,
Right.
the manufacturing and services employment components came in slightly weaker than their previous readings, with the services PMI employment falling below 50 for the first. 50 is a boom and bust level, isn't it? So when it's below 50, it came in at 48.5. It was well below last week's print, and it was the first time it went into contraction in 7 months. Which is
that's interesting.
Very interesting, isn't it? It's likely because of the Omicron spread in the US hitting the services sector. But nonetheless,
it could be.
Could be. This does point to a weaker headline number than what the market might be expecting today. So I wouldn't be surprised, based on this, that we might see a weaker than expected number. Still, I don't think that's going to matter materially for the market in terms of reaction.
Yeah.
So
let's have basically. The leading indicators that we mentioned are, just a point of guidance. They are not necessarily accurate.
Exactly.
There are discrepancies month on month, so it's much more difficult to have a full view of the non-farm payroll report ahead of its release.
Yeah. So ahead of the data, you can see the S&P futures are down, along with all the major indices. If I sort this out by percentage change, you can see the Italian market is down 4%. The FTSE is down 3%. Big falls, right? German DAX is down 3%. The French CAC is down 3%. Talking of the DAX, it's now lost its entire gains made last year. Wow, this is huge, isn't it? This was the low from 2021.
Basically, it's back to pre-pandemic levels, about February, March 2020.
In fact, it's gone even below that level, hasn't it? The DAX.
Well, yeah, but I'm saying about
around that
where
area,
it was trading in February.
In January,
yeah, January, February. So, it seems like a massive breakdown. We did expect that to happen. I think we have stressed out that the bearishness of the trend in especially in European indices is overwhelming, and there is no end in sight. The US is currently benefiting from safe haven flows, because obviously the US is not in Europe, so there is no war next door, and money is definitely flowing out of Europe into the US some repatriation, I'm sure, on part of US investors.
Yeah, it's a complete reversal, isn't
it?
From the trend of a few months ago when money was flowing into European markets from the US, from overvalued US stocks. So
yeah.
But that being said, it's not the U.S. markets are not doing particularly well anyway. You know, there are some sectors and stocks, individual stocks that are doing decent, but on the whole, indices in the U.S. are not doing great either. I mean, they're holding their own relatively better than the European markets, but it's the same kind of bearishness, isn't it, in the U.S. I mean, if you look at the Russell here, the weekly chart broken down. If you look at the S&P 500 weekly chart, it's broken from its bullish channel. The Dow has also been creaking. NASDAQ, same picture. So the weakness is everywhere in global markets. It's just that the European markets are breaking down faster, as Victor mentioned, because of the situation in Ukraine. Where do you see the US markets heading then, and especially in response to today's jobs report, Victor?
Well, I do expect that the market will react to a stronger jobs report because it will mean that the Fed will be more reluctant to let their foot off the brakes once they start pressing on it. What I mean by that is that once they start hiking rates, the market is going to probably, a lot of this it's priced in, but I gotta say that we're still data dependent. Like the hotter the US economy, the faster the rate hikes are gonna come. There's no doubt about that in my mind. Only massive escalation into World War III probably is going to there, but at that point in time, I don't think we're gonna care much.
No, exactly. Interesting. You mentioned that. So you feel that if we get a strong set of data, regardless of the situation in Ukraine, that this will potentially be bad news for the stock markets in the US? Is that what you're trying to imply?
Yeah, I think so. Depends how bad, of course, and also, I mean, depends how good of the data is. I'm also like during the current month, the Ukrainian, sorry, not the current, but the previous month, February. The Ukrainian crisis is not likely to be seen in the non-farm payrolls report. However, next month and the months after, I do expect that US companies will actually benefit a lot from gaining competitiveness versus European companies.
Yeah, I agree.
Because energy prices in Europe are much, much higher. And they're going to try to even start if they have production bases both in Europe and the US, they're going to ramp up production in the US and cut production in Europe. So I mean, it's really, really complicated and really, really scary what's going on.
Yeah, indeed. Now, in terms of technical analysis, obviously, this is what we focus mostly on when thinking about what the markets in terms of near-term direction. It's interesting that we have seen this hammer candle on the weekly chart of NASDAQ last week. Yet, deep into this week, the weekly candle is red or black in this case. And this goes to show that there's a lack of willingness from the bulls to come out which is understandable given what's happening around the world in Ukraine and everything else, and with rate hikes and whatnot. And so you can see that there's a bit of a failure here in terms of the bulls should have held their own above the last week's high when it printed a hammer candle on the weekly. This is a 1,000 point more and 1,000 point plus rally from the lows. And the fact that we are in the negative territory for this week after taking out liquidity above the high of the previous week's candle. To me, this looks quite bearish. And I think that it's possible that the market may now go on and drop to take up liquidity below the previous week's low, which is this level right here. This would be a massive drop, and whether or not it will happen or happen today remains to be seen. But it's a strong possibility, in my view, that the market might be heading lower from here, given this failed breakout attempt from the bulls. So that's if that happens, you know, we're going to see a massive slide and massive aversion and risk, which should be good news for certain commodities, for example, gold, right? So if I go to gold, you can see that the precious metal, this is the weekly chart of gold, you know, last week
looking
it
bullish,
yeah.
It only has to close above 1980, and we might have a very, very sharp and brisk rally, because people are slowly realizing that perhaps this is the best way to save their money from depreciating in value, as we have seen over recent days. Commodities have been rocketing higher, even despite such a news item as the Iranian deal being around the corner, and basically what is this? Wheat? Oh my God.
Look at this. This is directly related to the Ukraine and Russia situation. People, Russia is a major supplier of wheat, along with Ukraine and other grains as well, not just wheat. There's other stuff as well, but mainly wheat and a few metals as well.
Well,
and,
I see that you have corn and soybeans. Perhaps we should just up.
Not so much soybeans, but corn. There you go. Corn has broken the previous high.
It's I don't think that there's any doubt about commodity prices going higher from here. If you look at palladium, look at copper, you have it next. It's next after corn, down there. It's
that's copper.
HG is copper.
That's copper breaking out.
So
this is good news for silver,
out,
isn't it?
Palladium, it's
looking really.
It's close to all-time highs. Russia is one of the biggest producers of palladium and aluminum.
Aluminum is here. Ooh, look at that, massive. So is gold and silver next then? Would you say, because we haven't seen the same sort of
no, we haven't. I mean, people are more worried about real assets, so it makes sense. Still, industrial use of gold and silver is not as big as for the other commodities. So this is the reason why we're still catching up. We're still not. I mean, while aluminum has rallied 50% since last year, gold
not so much.
Been, rather modest.
Not modest.
But obviously it's much more difficult for our audience to trade metals such as
I was going
copper
to say,
or aluminum or so.
Yeah, that a lot of our audience, they would typically be trading metals like gold and silver rather than some of the other base metals. So hopefully, if you're long or bullish, we might see that breakout. I mean, 2000 is in sight now, isn't it? And why stop there if it gets there? Why not go to a new all-time high?
I want to stress something else out as well. In the FX market related to this, you can see that the Aussie and the Kiwi have actually decoupled from the traditional risk trade.
Oh, right. Yeah. Aussie's up. Yeah. New Zealand's up.
We have had a stock market decline, which traditionally has been associated with the Aussie going down. But this time around, the Aussie and the Kiwi are rallying simply because they're so far away from the action that investors feel that their money is safe there.
And also these commodity currencies
and commodity prices,
because of commodity price, of course, are rallying.
Because Australia is one of the biggest alternatives to Russia in terms of supplies of so many base metals that it's crazy.
Absolutely, yeah. So in contrast, if you look at the euro dollar, well, the euro dollar sank below 110 level as we had previously highlighted the possibility. Well, it's done it finally, but because of different reasons, namely because of the situation in Ukraine. Obviously, the exposure of European banks and whatnot to Russian institutions is significant, isn't it? They're neighbors. So anything that happens to Russia is going to negatively impact the Eurozone economy. And we're seeing
every
evidence
day this war goes on, the more money is fleeing out of Europe into the US. That's basically what's going on here.
Yeah. So bringing the focus back to the jobs report then, Victor, before we wrap this up, how would you trade the markets based on the data released today? Before you answer, I would like to say that sentiment is bearish. So I would concentrate on finding trades that are kind of risk averse, meaning that I would be in favor of shorting indices or going long gold and silver, regardless of the data. But would you agree with that?
And going long on the dollar as well. Even if we have a disappointing number, I would take that as a dollar buying opportunity.
Which currency pair, though?
Not against the yen.
Not against the yen, yeah.
Mainly against the euro and the pound.
Right. So the euro has already broken the 110 level, and this doesn't mean that it will stop here and then rally again. Okay, so let's find a few specific levels where we might be interested in trading this short. And one such level for me would be this area here around 110. I call that 110, which was previously support. So if we get a bit of a rebound into that level and when the jobs report is out, then specifically I would be looking to potentially sell into that bounce to take us to a new low on the session. So that's one trade idea that I might or Victor might exercise later this afternoon. In terms of other currencies, do you have any other currencies that you might look to trade apart from the euro dollar, or is this your favorite one?
Well, I think that it's worth having a look at perhaps commodity currencies, as mentioned, and there, on the contrary, I would be going long on commodity currencies. Mm-hmm. And since we're bearish on the euro, why not go long the Aussie, the euro Aussie dollar?
Interesting. So euro Aussie,
go a bit more exotic.
Yeah, that's a really interesting point. Euro Aussie. Look at that.
There you go. It's yeah, it's a
it's a
very
bit risky
strong
though, isn't it? I
trend,
mean,
and
if you are trying to chase momentum here after price has been down several days in a row.
After this move, yeah, no, I mean, it's just, yeah. I know. I know how it looks.
Yeah.
I just don't think that it's
done.
stopping anytime soon. Yeah.
Maybe this level here at the 149.50-ish. If we get rebound into that and then try to see if there's a short-term sell setup there. In terms of commodities, then let's go to gold and let's talk about the specific level before we wrap this up. On gold, I would be looking to go long, obviously. Even if this reverses, I don't think I'll be exercising any short trades on gold simply because of the situation in Ukraine and everything else. Yeah. So for me, gold is a long in any case. So when the data's out, if we see a bit of a pullback into this blue area, I think this area has already been retested. So maybe we can move this up a little bit into this zone here.
Yeah, perhaps. Yeah.
Somewhere around here, if we get some bullish price action or whatnot, try to look for a long trade there. Alternatively, if we get a break above this level, see resistance. If you get break above that, then you could look to potentially go long on the retest of that level on the way down. And then that could hopefully take us to above these highs and potentially much higher over time. So yeah, those are the specific levels and trades that we're going to keep an eye on. And so before we wrap this up, thank you so much for joining us. And for those of you who are watching a recording of this, please consider joining us live next time so that you can ask us questions. We're going to end the recording here and allow everyone that's here to ask us questions for our regular Q&A session. Take care and be safe out there.
Take care. Stay safe in these markets.